2020 was Cathie Wood's year. All her predictions were coming true. She was riding high on the Fed-driven bull market, but everything went downhill from there. The Cathie Wood's fund's performance plummeted in 2022, losing over 70% value between November and June. However, the ARK Innovation Fund has just begun a strong comeback with its flagship ETF, which is up 40% from its recent lows. Cathie has titled her most recent video update Resisting Recession, and she has some fantastic predictions for the future months. And her theory may surprise you. It's an honest opinion of the economy from someone who expects to suffer if the worst is yet to come. The complete video is over 40 minutes long, but today we'll only go through the few items that I believe are both logical and realistic. Stick to the end of the video to find out how the housing market might drop by up to 20% in more than 180 American cities. We note that the United States is officially in a recession as per the most recent GDP data. Unless you believe the White House, of course. It looks like the markets are in a strange and confusing state. On one hand, the official employment figures are good, the stock market is once again on the upward, and several CEOs reported great results in the latest round of earnings. But on the other side of this coin, numerous worrying events have occurred recently, and the geopolitical climate is currently unpredictable. A significant oil and natural gas disruption has created problems in numerous European businesses. A gigantic real estate bubble in China appears to be bursting, while here in the United States, tremendous inflation is driving rates up at a rate not seen since the early 1980s. With winter rapidly approaching, it is unclear how everything will turn out. So many uncertainties and so much danger, and yet the markets only fell about 20% and are now only down about 10%. And everyone is speculating on what will happen next. Is this a fake bounce, or are we heading into chaos? Most bear markets, especially the extreme ones, have rallied after the initial drop that fooled investors into thinking everything is fine and on its way back up. This was most famously seen back in the 1929 crash. When you read about the crash, you don't know that the Dow Jones dropped close to 90% from its peak in September of 1929. It took more than 25 years for markets to rebound to pre-crash levels. However, what is sometimes forgotten is what happens after the first fall. From mid-November to mid-April 1930, the Dow Jones Industrial Average rose 48 points. Nobody understood that was the start of the largest economic collapse in American history at the time due to the subsequent sucker bounce. The Dow Jones fell 80% by the time the bear market bottomed in 1932. As the market recovers today, everyone is concerned about this scenario, and according to Cathie Wood, we're still in the middle of chaos. Here are 3 points Ms. Wood made to support her notion. Number 1, consumers are shutting down. The first is that consumers make up the majority of the economy. Cathie mentioned earlier this year about retailers having a tremendous amount of goods that they couldn't get rid of without absurd sales. And now it appears that this situation remains, showing that consumers aren't buying or willing to spend despite significant discounts. Cathie Wood said, "I think we're in a recession, and we've talked about this, we won't go into it too much. But the inventory builds up that Walmart, Target, Home Depot, and Costco, all of them were describing in their April quarters. They do not seem to have gotten them under control. If the macro indicators are any indication, we've got on both the wholesale and the retail level, month-to-month increases in the 1.5% to 2% range. Now, if GDP is revised up, it could even be revised into positive territory because of inventories that won't take us off this recession." This thought that we're in a recession because inventories are piling up because consumers are shutting down. So with stores overstocked and Michigan's consumer sentiment survey at an all-time low, lower than it was in 2008, we have to question what's actually going on. By the way, are you enjoying this video? Please give it a like and hit the subscribe button if you like content about business, economy, and crypto. It really helps me grow the channel. Number 2, the yield curve inversion. Her second point goes hand in hand with this. As far as we know, the yield curve is one of the most reliable recession indicators. Yield curve inversions, which are rare, are viewed as a good recession predictor because they suggest that investors believe, with the interest rate on long-term bonds being lower than the rate on short-term bonds, that economic growth is slowing. Every recession in the past 60 years was preceded by an inverted yield curve, according to research from the Federal Reserve Bank of San Francisco. And as you can see in recent weeks, this inversion has become significant, which is giving us a clear signal that is hard to ignore. It is also the deepest 10-2 yield curve inversion since 2000. Cathie Wood has become bearish following this development in the bond markets. Ms. Wood said the interest rates are down almost 70 basis points to 2.83%. Meanwhile, short-term interest rates, 2-year Treasury yields, they have moved up in lockstep. They're at 3.24%. So now we have an inverted yield curve to the tune of 41 basis points. It's just getting more and more inverted, and that's basically the fixed income markets telling the Fed, okay, something's going to give. Here is going to be the economy, which is caving in many ways, or inflation, or both. And we think the answer is both. And we also think the surprises are going to be quite significant on the downside when it comes to inflation. And that brings us to Cathie Wood's final point, the housing market stagnation. As you may know, housing accounts for 15 to 18% of GDP. And with news of slowing sales and price drops, there is fear that this downturn may worsen an already terrible situation. For example, Cathie Wood has said that Robert Shiller, the man who literally helped establish one of the most widely used housing indices, the renowned Case-Shiller Index, is expecting a 10% drop in home prices. He recently appeared on Yahoo News to discuss this subject, and he pointed out that the futures market is showing a considerably bigger collapse than the widely held belief of experts. Robert Shiller said, "It's not necessarily a bullish indicator. It looks like we were misplacing our judgment because of that. I like to look at the futures market, which most people don't, because it's not a very liquid market. But the Chicago Mercantile Exchange has a futures market in a home price index, the Case-Shiller Standard, and Poor Home Price Index, and that's in backwardation. Now, our prices are expected to fall by something a little over 10% by 2024 or 2025. That's a good estimate. That's the market at the moment. Meanwhile, a new study done by experts at Moody's Analytics says that if the US economy enters a deeper recession, housing values might decrease by up to 20% in more than 180 cities nationwide. Homes in 183 of the 413 largest regional housing markets in the country are overvalued by more than 25%. A map based on data from Moody's was published by Fortune. It showed that home prices were poised to fall in so-called bubbly markets like Phoenix and Boise. Considering all these difficulties, it's no surprise that many people are starting to think that this is a sucker's rally. Another market head deception before the actual agony hits. It's tough to know who to believe when so many different data sources signaling both bearish and bullish directions. On top of that, with one mishandled bombshell or poorly phrased remark, Europe or our Fed may easily change the path of this market. Where it goes from here is unknown, but Cathie Wood believes we should be skeptical of the recent rally. Is this a temporary stop to a 13-year record-breaking bull market, or are we going to be in the middle of the woods for a long time? Let me know in the comments below. If you learned something new from today's video, click the subscribe button and hit the bell icon to be the first to see my next video. I make deep dives like this every week where I uncover the secrets of money and business.